In almost every area of life, we're taught this really simple equation. Maximum effort equals maximum reward. If you want to be a top athlete, you train harder. Want a promotion? Put in more hours. It's totally ingrained in us. But when it comes to building wealth in the stock market, well, that equation gets turned completely upside down. Welcome to this explainer, where we're going to dive into the very real cost of activity and why, mathematically speaking, boring investing almost always wins.
It's the ultimate question, isn't it? Does working harder, sweating over charts, and actively trading the markets actually make you richer? Society, and let's be real, those heavily marketed trading apps, certainly want us to believe that active trading is the obvious path to success. The action feels incredible, and sitting still, it kind of feels like you're just leaving money on the table. But as you'll see, there is a massive difference between feeling like a winner and actually building real wealth.
Okay, to see how this really plays out, let's set up a completely fair playing field. We're going to follow 3 characters. They're all exactly 30 years old, they all earn the exact same salary of 75 grand a year, live in the same city, and they're in the same tax bracket. Most importantly, they have the exact same goal: turn the stock market into real wealth and retire comfortably at 60. Over 30 years, they will each put exactly $1,000 into the market every single month. So, same money in, $360,000 total. The only thing that's different is what they decide to do with it.
Let's meet the lineup. First, we have Tyler. He decides he's going to beat the market. He learns to read charts, studies candlestick patterns, watches the open every single morning, and trades frantically in and out of positions all day long, hunting for those moves everyone else is too late to catch. Then there's Greg, taking a slightly calmer version of that same idea. He's a swing trader, holding his trades for a few days or weeks, swinging with the trend. And finally, we have Ryan. Ryan does almost nothing at all. Every single month, he buys one low-cost S&P 500 index fund, and then he just closes the app. No charts, no timing.
Now, for the first couple of years, Tyler looks like an absolute genius. I mean, he hits a hot streak, posting these 4% weekly gains while Greg and Ryan are totally flat. He's firing off screenshots to the group chat, talking about his edge, and he's completely convinced the other two are leaving money on the table. At a weekend barbecue, Tyler has the exciting stories. Greg has opinions on market trends. Ryan, he has absolutely nothing to say because, hey, I bought the index again isn't exactly a great conversation starter. On the only scoreboard Tyler ever checks, this week versus last week, he is convinced he's winning.
And then Tyler has the year that convinces him he's right about everything. A couple years in, the market runs hot, his trades line up perfectly, and he posts a monster 12 months. He beats Greg, he beats Ryan, he beats the market itself. For one glorious stretch, he is unambiguously the smartest guy in the group chat. He even starts doing the math on quitting his job to trade full-time. This, he decides, is the proof. But here's what Tyler can't see yet. There are invisible mathematical forces working against his active strategy every single day. Wall Street understands this math perfectly, but Tyler's app conveniently ignores it. The spring after his monster year, well, the IRS sends the bill. Because Tyler holds his investments for less than a year, which is literally every single trade he makes, his profit is taxed as ordinary income. For a $75,000 salary, that's a 22% federal tax rate. By the time the dust settles on his great year, most of what he made has handed itself right back, half in losses and half in tax. The IRS takes a 22% bite out of every single winning trade before that money even has a chance to compound for his future. But Tyler truly believes that good years are repeatable. And that one belief keeps him right there in the chair for the next 28 years. And the leaks don't stop at taxes, folks. There's the friction. Every time Tyler trades, there's a cost. You've got the spread, the occasional fees, the slippage. Plus, the trades he loses, yeah, those don't make it to the group chat. Tyler churns his entire account value easily 20 times a year, and this friction quietly evaporates roughly 2% of his money annually. His money is bleeding away before he has made a single dollar of actual profit. The market doesn't even have to beat Tyler. His own frantic trading does the job for free. Then there's the statistical reality, which is just brutal. Landmark research tracking everyday trader in a national market over a decade found that fewer than 1% of them earned reliable profits after costs. Other studies show over 8 out of 10 day traders actually lose money entirely. But for the sake of this explainer, we are going to be incredibly generous. Let's pretend Tyler is in that tiny fraction who actually makes money.
So why does Ryan's do-nothing approach fundamentally win? Well, Tyler and Greg are constantly triggering taxable events, paying high-friction costs, and fighting the market tooth and nail. Ryan, on the other hand, almost never sells. His money compounds entirely untouched by taxes for decades. He pays practically zero fees, and he simply tracks the market. Ryan has total control over when his taxes are paid.
All right, let's take a look at the 30-year chronological scoreboard. And remember, we are giving Tyler the highly generous assumption that his active day trading is actually profitable. We are giving him the absolute best-case scenario here. Let's see what happens when compounding does its quiet yet incredibly violent work over 3 decades. By year 10, the lines on our chart have officially separated. Tyler is sitting at roughly $134,000. Greg is a bit ahead at $154,000. But Ryan, the guy who just buys and logs off, he is already at $192,000. He's quietly pulled ahead by almost 60 grand. But Tyler is completely unaware because he's only comparing his portfolio to his own performance last week, not to Ryan's boring, invisible progress.
Jump to year 15, and honestly, it's not even a close race anymore. Compounding is heavily accelerating now. Tyler is at $213,000, Greg is at $264,000, and Ryan has surged to $373,000. While Tyler's chart spikes and crashes in this frantic attempt to get ahead, and Greg chops along with moderate swings, Ryan's boring line simply rises, relentlessly and steadily upward.
And here is the ultimate reveal. At age 60, after putting in the exact same $360,000, Tyler finishes with $511,000. Greg ends with $812,000, but Ryan, who did almost nothing, crosses the finish line with a staggering $1.778 million. He finishes with more than 3 times what Tyler built. He is nearly $1 million ahead of the hardest worker in the group. Tyler didn't lose because he wasn't smart. He lost because the basic mechanics of taxes and friction ran against him every single day.
It's a really tough pill to swallow, financially for sure. But there is one more cost to Tyler's story. We've measured everything so far in dollars. Now we need to shift our perspective to the massive emotional gut punch of the time Tyler spent staring at screens. We have to line this up in the one currency he can never, ever earn back. Check this out. Tyler was glued to his monitors for roughly 2,000 hours a year. Over 30 years, that is 60,000 hours. That is the equivalent of working a second entire full-time career for 3 decades. Ryan spent maybe 4 hours a year clicking buy. That's about 3 working weeks total over 30 years. Tyler literally paid with a second lifetime of labor, 60,000 hours handed over, just to finish dead last by nearly $1 million. So how do we avoid Tyler's fate? Look, the psychological urge to do something, to feel in control of your money, it's very real. I'm not going to pretend that goes away. But you absolutely cannot fund that urge with the money meant for your future. Here is a realistic, actionable playbook for handling that desire to trade without ruining your financial life.
Step 1. Build your core wealth, at least 95% of it, in low-cost index funds. That is your boring engine, and as we've seen, it flatly wins on math. Step 2. If you genuinely have the itch to trade, wall off a maximum of 5% of your money in a tax-advantaged account like a Roth IRA, and treat it like a casino. Have your fun, but don't let it touch your future. And step 3, be brutally honest with yourself. Measure your active returns against the index. Stop mistaking frantic activity for actual financial progress.
The reality is, the market simply does not pay you for effort. It pays you for profound patience. Ryan proved that by holding the entire market. But it kind of makes you wonder, doesn't it? What if you bought just one single great company back in 1995, closed your eyes, and just forgot about it for decades? The numbers that come back from that kind of extreme patience might be the most surprising math of all. We are going to unpack exactly that in our next explainer. Thanks for joining me, and stay focused.